Hello and welcome. As every week, we are going to talk about some of most shorted stocks. Be sure to subscribe and drop your comments. Now, let's dive in.
Okay, let's talk about BDRX. How can traders be so sure a stock's gonna tank?
Well, it's not a guess. It's about reading the financial writing on the wall. It's called a structural short. You're betting against the company's own financial engineering.
And BDRX is a textbook case of how this whole thing plays out in the real world.
So the first big red flag popped up months before the deal even happened. Back in July, BDRX did a reverse split to pump up its stock price for NASDAQ.
But to experienced traders, that's not a power move. It's basically a cry for help.
Because all that higher price really does is give the stock more room to drop.
Okay, Section 2. In December, they announced the deal that was basically game over. They sold these units with 1 share and, get this, 2 warrants. A super sweet deal.
Yeah, that 200% warrant coverage, that just screams desperation for cash. Absolutely screams it.
This setup created a perfect arbitrage play. Buy the cheap unit, short the stock. Instant profit.
And get this, it was a best efforts deal. That means the bank took on zero risk.
That's a huge tell. It means regular institutional investors likely wanted no part of this deal. All right, let's get into the math. This is where it goes from a theory to a certainty.
So remember, the float was super thin. We're talking only about 619,000 shares out there. Then, bam, this new offering suddenly floods the market with around 3 million new shares.
I mean, do the math. That's a 480% increase in supply overnight. Just insane. And this chart shows it all. It's a massive supply shock. There's just no way to absorb that.
So what happened when the deal closed? The trading data tells you everything you need to know.
Look at that. Over half the volume was short selling. That's the deal's buyers hedging.
So you put it all together, and you get a very predictable outcome. The death spiral.
It's the classic dilution spiral. Every time they raise cash, they dilute shares, killing the price.
So what's the big takeaway? A stock's fate can be written in its financing documents.
The lesson from BDRX, sometimes a stock doesn't just fall, it's pushed.
Let's unpack the wild story behind Mara. It's one of Wall Street's hottest crypto stocks. Most people just see it as a bet on Bitcoin. If Bitcoin's up, Mara's up. Simple, right? So why in the world is there a massive billion-dollar bet against it? It's a real puzzle. Right now, more than 103 million shares of Mara are sold short, a massive number. We're talking about nearly 28% of its public shares. That is a huge bearish position. But this isn't about simple pessimism. No, there are 3 really sophisticated forces at work here. First up, we've got the institutional hedge, a classic Wall Street play known as a dispersion trade. Here's the play. Go long on Bitcoin ETS, but short Mara stock to hedge their bets. And why Mara? Simple. It's super volatile and easy to trade, making it the perfect hedge. But hedging is only part of the story. There's also this hidden, almost mechanical selling pressure. This second force is called convertible arbitrage, and it creates a constant drag on the stock. Basically, funds buy the company's bonds and then short the stock. This creates constant mechanical selling. The key takeaway? The selling isn't a bet against Mara. It's just a mechanical process. And that brings us to the third force, and this one is a paradox created by Mara itself. See, Mara doesn't sell its Bitcoin to grow. Instead, it issues new shares to fund operations. And that, my friends, is called strategic dilution. It funds growth, but slices the pie thinner. So if shares grow faster than their Bitcoin pile, each share is actually worth less Bitcoin. And this can hold the stock price down even if Bitcoin is absolutely soaring. So let's put it all together. You've got 3 totally distinct forces all pushing on the stock. You have the hedge, the mechanical selling from arbitrage, and the company's own strategic dilution. This shows high short interest isn't just about bears being pessimistic. It's often about market structure. So it makes you wonder, right? When you buy a stock, what hidden forces are you really buying into? Okay, so let's talk about Applied Digital. They've got this huge story in the booming AI space. They're seen as a key player building the very backbone for artificial intelligence. But why are so many big players betting billions that it will fail? Let's unpack that. While the whole argument against them, it's all driven by activist short seller reports. Basically, they're saying the company exists to make its backers rich, not its regular shareholders. And critics are pointing to some really big governance issues here. Shorts call it category fraud. It's valued like a tech firm but runs like a simple utility. All right, let's look at the books. This is where things get really interesting. For their second quarter, revenue was almost $64 million. That's a pretty big number. But hold on. In that same period, they lost a whopping $138 million. Let me put it this way. They're losing more than $2 for every $1 they bring in. And this specific line item, it really sets off alarm bells for people digging into the numbers. Okay, so given all that, where's the smart money betting? Well, the data is pretty clear. Get this, about a third of all their publicly traded shares are sold short. That's around 80 million shares in total. An absolutely enormous bet against the company. So yeah, this isn't some small-time speculation. We're talking about a massive capital bet here. A lot of this trading doesn't even happen on public exchanges, but in dark pools. You can see it right here. Their off-exchange short volume is way higher than average. This is what makes it a classic battleground stock. You've got two completely opposite stories clashing. So here's how it all breaks down. The bull case versus the bear case. It's a total showdown. So it all comes down to this. When the story and the numbers don't match, which one do you believe?
All right, let's break down the short thesis for Mawson Infrastructure, ticker MIGI.
Just recently, the stock absolutely cratered after a pretty significant corporate move.
So why the huge drop? Well, it all boils down to some serious operational distress.
The core issue? Post-halving economics. That event basically crushed their ability to make money.
And yeah, the numbers don't lie. Monthly revenue took a nosedive, and their core mining biz is fading.
Even their pivot to AI is getting some serious side-eye. Bears think it's just buzzwords.
This pressure forced their hand. They did a 1-for-20 reverse split to stay listed. Think of it like this. You're swapping $21 bills for a single 20. Same value.
So what's the big deal? Well, that new higher price is basically a green light for short sellers. Before, the stock was too cheap for big funds to short. Now, it's fair game.
And you better believe the smart money noticed. They're making moves in the market's shadows.
Okay, and this is wild. Over half of all the short volume is happening off exchange. That means retail buy orders can get swallowed up without ever moving the public stock price.
And get this, almost 1 out of every 5 available shares has been bet against the company.
For a stock with such a tiny float, that is a massive, concentrated bet to the downside. All of this is creating what's known as a death spiral. Let me show you. The price falls, they split, shorts attack the new price, and it all repeats. That's the playbook.
So the big question is, with revenue collapsing and shorts piling in, can MIGI break free?
All right, let's get right into it. The high-stakes standoff over SOUN Ally. So we've got this NVIDIA-backed AI stock that's just soaring. But pros are betting hard against it. Why? This is way more than just a stock ticker. It's a full-blown battle between the bulls and the bears. So why are the pros so bearish? Well, it boils down to two things. First up, it's crazy valuation. Basically, the price has just gone parabolic, completely detached from what the company is actually doing. And here's why. We're talking 20 times revenue. It's not profitable, and growth could really slow down. Okay, argument number 2 is even bigger. It's about whether SoundHound can even survive against big tech. And this really gets to the heart of it. Is voice AI its own unique product or just a simple feature? This is what they call commoditization. Why would anyone pay for something that's becoming a free feature? So that's the argument against it. Now, let's see how this is all playing out in the market itself. Get this, almost a third of all tradable shares are being shorted. That's a huge bet against it. And this number, 7.24, is so important. It's called the days to cover. That means it takes shorts over 7 whole trading days just to get out of their positions. And that creates a powder keg. You see, any good news could trigger a massive short squeeze. But wait, it gets crazier. Over half of this short selling happens off exchange in so-called dark pools. What does that mean? Well, all this hidden selling can seriously weigh the stock price down. So what's the takeaway? This analysis calls SOUN the single most dangerous stock to be shorting right now. So let's break it down. You've got a solid bear case clashing with some incredibly risky market dynamics. Which brings us to the ultimate question, is this a bubble about to pop or a squeeze about to launch?